Okay, and welcome back, students who are taking financial accounting, and in this series of videos we are working on the Chapter 1 short exercises. Just as an FYI, if you don't understand something, pause, rewind, watch the video again. That's the beauty of videos. You can watch them as many times as you need to absorb the information. And if you still don't understand something, feel free to either telephone or email an instructor. Okay, so let's pick up where we left off. And we had finished 1.7, 1-7, so we're on short exercise 1-8. Okay, so it says here, enter transactions in the accounting equation. All right, so Sanchez Towing Service Inc. earns service revenue by towing vehicles for AAA. Its main expenses are salaries paid to its employees. Okay, so revenues is a category of account, and expenses is a category of account. Account for the following transactions in the expanded accounting equation. Okay, so if you recall, the accounting equation is assets is equal to liabilities plus equity. Now, the textbook goes and it expands the equity section to include revenues. So we're going to add revenues, we're going to subtract expenses, and then we're also going to subtract dividends. Okay. So the expanded accounting equation would look like assets is equal to liabilities plus revenue and plus equity, plus revenue minus expenses minus dividends. Okay, so that's the expanded accounting equation. But if you recall, I don't like using the expanded accounting equation for the simple reason that your basic accounting equation is on the balance sheet, okay, whereas your revenues and expenses are on the income statement, okay, and dividends come out of the profit or loss, right? And if you recall from the intro videos, the profit or loss that we have from the income statement gets moved to the equity section, and that's how we can create the expanded accounting equation. So notice what I just did. I had said when you're working through problems, you read slowly and think about what you're reading. And as I thought about the expanded accounting equation, that was everything that was in the back of my head. And I just put, sure, when I'm doing it myself, I know it's there. I don't have to think that much about it, but I did write it all down on, on the screen here so that you can see what was going on inside my head. Okay, and that's the same thing that you should be doing. You shouldn't just read this like it's a romance novel. You need to be thinking actively about the information that's being presented. Okay, so we have transactions. Okay, and A and a B. So we'll start out with transaction A. Now, if you recall, when you have a transaction, you enter it into a journal. In other words, you make a journal entry for it. Okay, when you make the journal entry, you're going to have debits and you're going to have credits. Okay. In this case here, Sanchez Towing Inc. earned $62,000 of service revenue on account, right? Now, if you recall from the processes that I had spoke about in earlier videos when making journal entries, I had said and I believe they're in that thought process is in the later intro videos. But I had said whenever you have a transaction, and this is the way I go about it, okay? For the simple reason that it's very easy to become jaded, meaning you'll see this transaction in the textbook, right? And as you move forward, it's very easy for you to go and say, oh, well, let me see, I saw this transaction before, let me copy it, let me mimic it, let me do it step by step from the textbook, instead of thinking through the process. I mean, even the most simple transactions, when you journalize them, you go through a thought process. It's better to learn the thought process for the simple reason you're always going to come across a transaction that you've never seen before, and it's not in the book. And you're going to have to be able to make that, or else it's wrong, or you're going to get the information wrong. So get accustomed to thinking through the process instead of looking it up in the book, right? It may seem like it's harder work up front, and in today's society, we want everything quick and easy, and we don't want to think down the road and whatever have you. And taking a short-term perspective ends up, almost always being the wrong perspective. If you spend the time right now developing the muscle of going through the process, then later on it becomes almost second nature. And when you come across that, situation where you don't know how to make a journal entry, you go through the process and you make the journal entry correctly. And you might be thinking to yourself, oh, well, why do that? Well, if you're sitting on a test and the test problem is worth 20 points and you don't know how to make that journal entry, you just lost 20 points. And that might cause you to fail. And if you fail a subject, then you have to retake the subject because you didn't learn what you needed to in the first place. So it's, you're looking for, short term, you're trying to avoid a little bit of the pain, but think about the greater pain down the road. So with that little bit of philosophy, okay, when I'm working through a transaction, the first thing I ask myself is, am I affecting cash? And my answer is going to be either yes or no. In a previous exercise, you saw what happens when we answer yes. Well, in this particular case here, it says I earned 62,000 of service revenue on account. Well, I'm not affecting cash. Okay. Well, if I don't affect cash, I said the second question I ask myself is, am I affecting accounts receivable or accounts payable? Okay. And that's going to be a yes or no answer there also. And remember that accounts receivable and accounts payable are two sides of the same coin. Meaning, if you understand how to do accounts receivable, then you just do the opposite and you understand how to do accounts payable. Because why? Accounts receivable is an asset and accounts payable is a liability. Well, if you recall from the previous videos, the accounting equation is assets is equal to liabilities plus equity, right? And the normal balance of an asset is a debit. Why? Because it's on the left, right? And what's the normal balance of a liability in an equity account? They're credits. Why? Because they're on the right. Now remember, the normal balance is what increases those categories of accounts. So a debit increases an asset and a credit increases a liability. Well, notice that if I have an accounts receivable, I'm debiting it. Well, I had said that accounts receivable and accounts payable are two sides of the same coin. So if I'm increasing an accounts receivable on the debit side, that means I'm increasing an accounts payable on the credit side, right? So that's what I mean by two sides to the same coin, right? So in this case here, we're asking ourselves, does this transaction affect cash? And we said no. So then we ask ourselves, does it affect accounts receivable or accounts payable? Well, whenever you see the words on account, that means on credit, which means it's either an accounts receivable or an accounts payable. Okay. Remember, accounts receivable is, you're extending credit to a customer. Okay. Someone is buying something off of you. For an accounts payable, the vendor is extending credit to you, meaning, because why? It's a liability. You owe the vendor. You owe somebody else. Okay. So the vendor is extending credit to you on account, and that would be in accounts payable. In this case here, it's telling you that you're earning service revenue. In other words, revenue is making a sale. Okay, so if I'm making a sale and I'm earning it, okay, but it's on account, then I must be using an accounts receivable. So if I'm using accounts receivable, and I had 0 before, and now I increased to 62,000, right? Accounts receivable is an asset, okay? Or the way you think about this is, well, accounts receivable is an asset. I do the same thing that I did with cash. I treat it the same way because I treat all assets the same exact way. It doesn't matter whether it's an accounts receivable or it's cash. So if my accounts receivable increases to 62,000 and accounts receivable is an asset, that means I'm going to debit it because I increase my assets on the debit side. So accounts receivable is a debit for 62,000. Okay, and then we know that debits must equal credits, so I have to credit something else, right? And the question is what? Well, I look at my categories: assets, liabilities, equity, revenue, and expenses. Okay, and it's telling me, I'm earning service revenue. I'm earning revenue, so it has to be a revenue account. Okay, and all I do is look at that category and I choose one of those ledger accounts that are under revenues. So this would be service revenue. Okay? And it's just that simple. I backed into that account. But theoretically, okay, um, remember, debit for an asset, credit for a liability, credit for equity. And the normal balance of a revenue is a credit, and for an expense, it's a debit. Why? Because if I have revenues less my expenses, I end up with a profit or loss. Okay, well, if my revenues, if they're credits, the normal balance is a credit and expense is a debit. Okay, and I'm just going to put numbers here: 100,000 and 75,000. Okay, well, the difference between the two is 25,000. And that's a profit. Why? Because I had sales greater than my expenses of 25,000, so I have a profit. And since my revenue was greater, it's a credit. So I have a credit of 25,000 here as a profit. Now remember, I had said up here, right, that the way I like to think about it is we close out our uh, revenues, expenses, and dividends to our equity account. Well, if I have a profit of 25,000, right, and that's a credit, well, I'm moving it from, my income statement, and I'm putting it into the equity account. Well, how do I increase equity? I increase equity on the credit side, so my profit has to be a credit. And if my profit's a credit, my revenues have to be a credit. Okay, and it's just the opposite for a loss. If my if my uh, if my revenues were 75 and my expenses were 100,000, okay, now I have a loss of 25,000. Why? Because my expenses were greater than my revenues. Okay, and of course that's a debit. Well, if I have a debit for 25,000, okay, and I'm moving that to my equity accounts, remember my equity account, the normal balance is a credit. Well, that's what increases. Well, since I'm taking a loss, I'm decreasing my equity, and my decrease is on the debit side. Okay, and that's how I move my loss into my equity account. Right. So that's the theory behind, what you're doing for the other half of that journal entry. Okay. So that's the, even though I could back into this here general ledger account, it's good to know the theory behind it to double check yourself. And when you are making a journal entry you don't know how to make, you are going to, you can back into it and be relatively sure that you have the right account, but it's always good to understand the underlying principles and theory so that, you can work through it and make sure it's correct, because right now I'm only dealing with two general ledger accounts, two line items. I mean, when you get more advanced, you could be working with 7, 8, 10 line items at a time, okay? And it's always beneficial to understand what's going on behind that, okay? So that's my journal entry, okay, for that transaction. And now let's do the next transaction, which is Sanchez here, and he's paying $33,000 in salary expense. Okay, so again, I have a debit and I have a credit, right? So the first question I'm asking myself is, am I affecting cash? Okay, and the answer to that is yes, right? Because I'm paying salaries. So if I'm affecting cash and cash is an asset, is my cash going up or down? Is it increasing or decreasing? Well, it's decreasing because I'm paying $33,000. Okay. Well, if cash is an asset and we increase our assets on the debit side, well, when we decrease it, that means we have to credit it. So our credit would be a credit to cash for $33,000. And because our debits have to equal our credits, I have to figure out what our debit will be. Okay. Is it an asset, liability, equity, revenue, or an expense? Well, it's telling us it's a salary expense. Okay. So I would look underneath the category of accounts for expenses, and I would look for the general ledger account that fits. In this case here, it would be salary expense, and that ends up being my journal entry. It obviously isn't an asset because we're not buying something we own, and we don't owe anything from a long-term like note perspective. And it certainly isn't equity because it's not an investment in the business, and we're not making a sale, so we're left with an expense, and that means we choose whatever account is under that. And this transaction is actually telling us it's for salary expense. Okay, so these are our transactions as we've made a journal entry for them. Okay. Now, from the journal entry, we post to our general ledger accounts. Okay. And remember, posting to the general ledger accounts, all we're doing is just rearranging the information. So here, this problem is saying account for the following transactions in the expanded accounting equation. Well, and forgive me for having to write, over the title here, but I have assets is equal to liabilities plus equity plus revenue minus expense minus dividends. So this is the expanded accounting equation, and what we're doing is we're going to post to these ledger accounts, and so we're just rearranging the information. So I have an accounts receivable, for 62,000, so that went under, that's an asset, so I have 62,000 under the asset because it's an increase as a debit. And I have a credit to service revenue, so underneath revenue I have 62,000. Okay, then I have a debit to salary expense for 33,000, so that goes under expense. And then I have again a credit to cash for 33. Now this credit to cash is a negative 33,000. Okay, why? Because remember, when we're looking at this, we try to deal in positive numbers as much as we possibly can. So the normal balance of an asset is a debit. So we show our debits as a positive and our credits would have to be a negative. So now we ended up, and that's why we put a negative 33,000. So now we do the math and we end up with 29,000 for our assets, and that's equal to 0 liabilities plus 0 equity plus 62,000 in revenues minus 33,000 in expense. And when we, so that's our, uh, you know, accounting for the transactions in the expanded accounting equation. But remember, the accounting equation always has to balance. So when we actually do the math here, and remember, these, our revenues, expenses, and dividends always get closed out to our equity accounts. So if we did that in the basic accounting equation, we have 29,000 is equal to 0 in liabilities plus 29,000 in equity. Okay, so our accounting equation balances at 29 is equal to 29. Right, so we're 21 minutes into this one exercise, and I didn't think it would take that long, but it did. So, and I'll try to, as we go forward, and we get more and more advanced, I'll stop going over some of the basic fundamental stuff and just tackle what needs to be tackled. But right now, it, it's beneficial to understand the underlying principles. I could have easily have just gone up to the expanded accounting equation up here and just plugged in these numbers like this. But if you understand, oh, come on, all of this, right, it makes it, you know, going forward, you're building up that storehouse of knowledge in the back of your head that you can pull out the tools that you need in order to work with your situation. Okay, so with that said, I will see you in the next video.